confused about these investing terms, and because of that, it prevents you to be able to learn new ways of investing in the stock market. You are not alone. As a matter of fact, many people are under 30 years old, 35 years old, I have trouble even understanding this. And you don't need to know everything. As a matter of fact, you just need to know a few things. Let me give you an example. I was in my house, I look at my closet, there are so many clothes in there that I'm not using it at all. 95% I don't use, I probably use 5%. So one fine day, I decided to clear my closet. I keep those that I really need. This is how it was before. This is how is it right now. Now I can find the clothes I can wear. Same thing for investing. What are the few terms for you to understand so you can move forward? You don't need to know everything. As a matter of fact, I'm going to post this link in this video here, where is the reference to get this content. And I like to thank MoneyWatch for this specific article because it was fantastic. So let me add a few things from this article to help you to understand more. First thing, term that you want to know is, what is the bear? What is the bull market? Bear market means market coming down. Bull is market going up. Now, how does it even happen? Because historically, bear, when they fight going down. So that's why market down. Bull, when they fight with the horn going up. That's why it's going up. That's how we explain. Is that quite cool? Simple. Next thing, what is the difference between stocks and what's the between bonds? What is the difference between them? Let's start with stocks first. Stocks are equity instrument, meaning you hold a certain number of shares in the company. You are an owner of the company. If you are an owner of the company, and when the company makes profit, they can distribute dividend. That is your share of the profit, depending on your percentage ownership of the company. Also, at the same time, the guarantee, the return is not guaranteed. They make money, and the company directors decided, and the shareholders decided to approve the dividend issue or your return, then you get the money. What are the additional benefits? You can attend the annual general meeting, you can vote against certain resolutions, certain decisions of the company, like the directors, auditors. You are part of that decision-making process as a shareholder. What's a bond? Bond is a debt instrument. It is like IOU. You're buying into a debt that have a guaranteed fixed return. Those are called bonds. Which also actually, when the bond has certain maturity period, once it's over, it's done, okay? So you better be able to understand where's the maturity period for it. Cool. Next thing, talk about this instrument. What is an ETF? ETF stands for exchange, T stands for trade, and then F for fund, meaning the exchange traded fund. Fund means money, F-U-N-D, forget. So let's do one thing at a time. The word exchange means it's actually traded into exchange, like a New York Stock Exchange, the stock exchange. Now, what is an ETF for? ETF represents a basket of stocks. It's a basket of stocks whereby instead of buying individual stocks, you can buy the entire basket of stocks that represent all the individual companies. Let's say, for example, have you heard about these things of S&P 500, which is represent the 500 largest company in US? Instead of buying the individually all the 500 companies, you can buy one stocks or buy one ETF that represent all of them. Okay, represent all of them. I will give you an example what that ETF represents in a moment. So the ETF can be traded in the exchange, and then actually it is a fund. So what happened is actually a fund is created, represent all the 500 shares as an example, and you can buy into that one fund, the ETF, and then you get also get dividend. You can trade, buy and sell it. Is that cool? Called exchange traded fund. Now, what's the benefit of actually having an exchange traded fund? The benefit is this. You have a certain level of safety. Like for example, if you buy the ETF for for the S&P 500, meaning that you can't have all the 500 companies bankrupt at the same time. Is that true, right? But if you buy one company, no matter how good they are, there's a risk that it can go bankrupt. True? Yeah, so that's called ETF. Now, what is this term called S&P 500 index versus Dow Jones index? Which one is better? Okay, there's nothing called better in it. S&P 500 index is an index represent the US stock market, 500 largest company inside that. 500 largest company. It is like a monitor. It's an indication how the economy of the US are performing with these 500 companies. Right? Dow Jones index is 30 companies. They have to be invited. They have certain criteria to be part of this Dow Jones 30 that represent these 30 companies that way. Cool. That's all the index. Yeah. So what is the S&P 500 and why is everybody talking about? Because we are talking about why do it because you can be able to trade the entire US market by looking at the S&P 500 index or the entire market using Dow Jones plus other like NASDAQ. NASDAQ, you can actually trade the technology company with this one instrument that way. Cool. So NASDAQ index is actually technology company with all the companies, all technology company inside there. And if you like to do that, you can be able to trade the entire index as well. Now, for a layman, how do you really do that? The way to do that is to actually use ETF. I told you before, ETF, exchange traded fund. You can trade ETF relating to the index. For example, you can buy the ETF on SPY. I'll show you the details here. SPY is an example, or you can actually buy DIA, which is Diamond, Dow Jones 30. Or you can actually buy QQQ, representing the NASDAQ. So it acts like a stocks that you can actually buy like a shareholder that way. So when they issue dividends, I think all these ETF, they generally issue dividends depending on which one, generally about each quarter. Is that cool? Or you can actually buy an ETF relating to commodity. Commodity like gold is GLD. That's the ticker symbol. Or you want to look at energy, commodity XLE, as I stated here. Or you can actually use the ETF that is inverse, meaning that it's actually reversal of what the market is. So say for example, you are looking at the financial index that you expect maybe it's go up, but what happened is maybe you think that this financial index has the tendency to come down, the reversal. Instead of shorting it, you can buy this specific index or ETF called the FAZ or FAZ to be able to do that. Okay, so you can do that. So it's the reversal of going up is coming down. Yeah, coming down. So when the stock price of this particular financial sector is coming down, this particular FAZ or FAZ is going up. So you make money from there. Cool? So look at the details. Is that helpful? So a short presentation like this, understand these terms. I also put in the Money Wash article. Read it, it's very easy to understand to give you a little bit more details. I hope this short presentation can help you understand better. And if you'd like us to find out more, there's a link that right below. You can connect us with us. Is that cool? Go for it.